Want to start investing but don't know where to begin in 2026? You're not alone. Most beginners make the same mistakes. Today, we'll break down exactly what you need to know to start building real wealth, step by step. One of the most powerful concepts in finance is compounding, and it's the #1 reason to start investing as early as possible. Think of it like a snowball rolling downhill. It starts small but picks up more snow, growing bigger and faster over time. Your money works the same way. It's not just your initial investment that earns returns, but the returns themselves start earning their own returns. This creates a powerful cycle of growth. For example, even a modest $100 invested every month in a simple index fund, which is just a collection of stocks that mirrors the market, can grow to over $15,000 in 10 years, assuming a 7% average annual return. Now, let's see what happens when we give that snowball more time to roll. If you continue that same $100 a month contribution for 20 years, your investment could become more than $40,000. Notice how it didn't just double. It grew exponentially. That's because in the second decade, you have a much larger base of money working for you. Time is truly your greatest asset when it comes to building wealth. This isn't just theory, it's a practical strategy anyone can use. Take Mark, for example. He started setting aside just $100 a month back in 2016. By automating his investments, he made consistency effortless. In just 5 years, his portfolio grew steadily. He didn't try to time the market or pick flashy stocks. He simply trusted the process, showing firsthand how consistency and time are the secret ingredients to long-term financial success. First up, stocks. When you buy a stock, you're purchasing a small piece of ownership in a public company. Think of it like owning a tiny slice of a brand you love, like Apple or Tesla. This is where you'll find significant growth potential. If the company innovates and succeeds, the value of your share can increase substantially. However, this potential for high reward comes with higher risk. A company's fortunes can change, and market volatility can cause prices to drop. For example, a beginner investing just $50 a month into a well-known tech stock could see noticeable growth in 1 year, but it's a journey with ups and downs. Next, we have bonds. In simple terms, buying a bond means you're lending money to a government or a corporation. In return, they promise to pay you back in full on a specific date, with regular interest payments along the way. Think of it as a formal IOU. Because their returns are more predictable, bonds are considered much lower risk than stocks. They won't offer the same explosive growth, but they provide stability and are excellent for balancing out the riskier assets in your portfolio, creating a more resilient investment strategy. For those who find picking individual stocks daunting, there are index funds and ETFs, or exchange-traded funds. These are brilliant for beginners because they offer instant diversification. Instead of buying one company, you're buying a basket that holds hundreds or even thousands of stocks or bonds. For instance, an S&P 500 ETF lets you invest in the 500 largest U.S. companies all at once. This spreads out your risk significantly. Investing just $100 a month into an S&P 500 ETF is a popular strategy that can lead to steady, compounded growth over a 5 to 10-year period. Finally, let's talk about high-yield savings accounts and CDs, or certificates of deposit. These are your safest options. Your money is FDIC insured, meaning it's protected up to $250,000. The trade-off is that they offer very low returns, sometimes barely keeping up with inflation. So, while they aren't powerful wealth-building tools, they are absolutely perfect for parking your emergency fund or saving for a short-term goal you need to hit within a year or two, like a vacation or a down payment on a car. They provide peace of mind and accessibility when you need it most. So, where do you begin? The first and most crucial step is to get a clear picture of your current financial health. This isn't about judging your past spending, it's about building a solid foundation for your future. Start by looking at your income and expenses to understand your monthly cash flow. How much do you have left over after all your bills are paid? Next, take stock of any high-interest debts, like credit cards. It's often wise to have a plan to tackle these before you start investing heavily. Finally, ensure you have an emergency fund. That's typically 3 to 6 months' worth of living expenses set aside in an accessible savings account. This safety net is what gives you the confidence to invest for the long term, knowing you're prepared for unexpected life events. With your finances assessed, step 2 is to define your goals. Why are you investing? Your answer will shape your entire strategy. We categorize goals into 3 time horizons. Short-term goals are things you want to achieve in the next 1 to 3 years, like saving for a new car or a big vacation. Medium-term goals might be 3 to 10 years away, such as a down payment on a house. And long-term goals are for 10 years or more, with retirement being the most common example. Knowing your timeline helps you determine how much risk you can comfortably take on. Step 3 is choosing where to invest. You'll need to open an investment account on a platform. For beginners, robo-advisors are a fantastic option. They use algorithms to build and manage a diversified portfolio for you based on your goals and risk tolerance. If you prefer a more hands-on approach, a traditional brokerage account gives you the freedom to buy and sell individual stocks and ETFs. Many user-friendly investing apps offer a hybrid of these features. When comparing, pay close attention to fees and account minimums. Even small fees can significantly impact your returns over time, so look for platforms with low costs and a user interface that you find easy to navigate. Now for the exciting part. Step 4. Start investing. You don't need a fortune. The key is to start small and be consistent. Consider Sarah, a beginner who set up an automatic contribution of just $50 a month into a low-cost index fund. By automating it, she never missed a payment. In under a year, her portfolio grew by over $600, thanks to both her contributions and market growth. This demonstrates the power of consistency. This brings us to a mini FAQ. How much should a beginner invest? There's no magic number, but the principle of paying yourself first is powerful. Even starting with $50 or $100 a month, invested consistently, can be the first step toward building significant wealth over the long term. The most important thing is to start with an amount that feels comfortable and sustainable for your budget. Chasing hot stocks leads to losses. Not diversifying, all eggs in one basket. Ignoring fees reduces returns. Emotional investing, panic selling during downturns. Investing doesn't have to be complicated. Start small, stay consistent, and watch your money grow. Let's recap. Start early, choose the right investment types, automate contributions, and avoid common mistakes. Subscribe to Money Booster for more tips, and join our weekly newsletter to get practical money advice delivered straight to your inbox.